As of June 2015, gross loans and advances by the banking sector amounted to 2.2 trillion shillings. Now, out of this amount, only 4%, translating to 89.8 billion shillings, went to finance agriculture sector. Now, this points out to the fact that the banking sector is still reluctant to finance the sector. And this is why.
Small farm households possess few valuable assets that they can pledge as collateral for agricultural loans, and this lack of collateral poses specific problems for lenders. For instance, the usefulness of farmland as collateral is limited by problems with ownership titles and certain legal procedures associated with foreclosure and weak land markets.
Personal loans tops the list of private credit at 23.6%, trade 20.8%, manufacturing 12.6%, real estate 12.4%, transport and communication 10.7%, and then agriculture at 4%. This despite the fact that agriculture sector contributes 22% to GDP and employs about 80% of the population. Last year, the sector accounted for 5.7% of the total non-performing loans.
The barrier to lending is not a lack of liquidity in the banking sector, but rather a lack of willingness to expand lending to agriculture.
Banks are now being challenged to overcome fears that lending farmers is high risk and instead develop financial products that suit the agriculture sector while at the same time attract youth into agribusiness to expand the sector.
The only way to improve our agriculture is to attract youth also into agriculture. As we speak now, the average Kenyan farmer is 62 years old. And one of the major issues, I mean it, 62 years. So if we are not careful, there will be no agriculture in another 2 or 5 years.
Global Communities, Kenya School of Monetary Studies and Financial Access now intends to build capacity within the banking sector through an executive certificate in agricultural financing.
There will be need to reapproach our view with respect to how agriculture is handled by the banks.
The training targets loan officers, loan analysts, and those underwriting agribusiness, comprising 150 from Kenya, 90 from Tanzania, and 60 from Malawi at a cost of 30 million shillings for a period of 1 year. Ronald Willie, News Hour Business.